You know how fast the world of virtual assets is moving? It's just incredible, like trying to catch lightning in a bottle.
It really is.
And as these digital innovations just keep accelerating, the big question, really, for governments, for regulators, is how do we ensure stability? How do we protect users, prevent misuse, and crucially, do all that without, stifling all that potential?
It's a really delicate balance,
Mhm.
yeah. And it's fascinating to see how different places are tackling it.
Yeah.
Today, we're looking at a really proactive approach, I think.
Absolutely. Today, we're taking a deep dive into Kenya's proposed Virtual Asset Service Providers Bill 2025. And just as importantly, that incredibly detailed report from the National Assembly's Departmental Committee on Finance and National Planning, the one that really reviewed the bill.
Hmm.
Our mission today: let's unpack this proposed legal framework, understand its core intentions, and really explore the crucial conversations and the proposed changes that have shaped it along the way.
And we're drawing directly from the bill itself, obviously, but also that committee report you mentioned. That report is, well, it's a goldmine, really. It's got invaluable insights from all the public participation, the feedback from stakeholders.
Right.
It's like a window into how a country is trying to get ahead of the curve on digital finance, learning from what's happening globally and building something hopefully future-proof.
So by the end of this deep dive, you should have a really clear picture of Kenya's ambitious steps to regulate this virtual asset space. We'll cover the key definitions, the new rules for operating, and give you a front row seat to those lively debates that led to the committee's recommendations.
Think of it as a shortcut, maybe, to
Yeah.
getting up to speed on a really cutting-edge regulatory development.
Okay, let's unpack this then. What exactly is this Virtual Asset Service Providers Bill 2025? What's its main goal?
Well, this bill, it was sponsored by the leader of Majority Party, published back on March 17th, 2025, and had its first reading not long after, April 8th. At its heart, what it sets out to do is pretty straightforward. Establish a comprehensive legal framework for licensing and regulating these virtual asset service providers, or VASEs as they're called, within Kenya.
And why now? What's the sort of the driving force behind this timing?
Good question. The bill itself is quite explicit. It aims to address the potential risks that come with the misuse of virtual asset products and services.
Like illicit finance.
Exactly. We're talking about serious concerns, money laundering, terrorism financing. These are risks in, any financial space that isn't regulated properly, and the digital world just adds new layers of complexity. So getting proactive with regulation becomes pretty essential.
That makes total sense.
Yeah.
And to regulate something this new, you've got to define your terms clearly. So what are we actually talking about when this bill says virtual asset?
Yeah, that's absolutely the starting point. The bill introduces several key definitions. And for virtual asset, the committee actually agreed with a stakeholder proposal to define it quite broadly.
Yeah.
Well, it's understood as a digital representation of value that may be digitally traded or transferred and may be used for payment or investment purposes.
Mhm.
But what's really interesting is it also includes digital representations of value meant to represent, like, real-world assets on a blockchain,
Okay.
whether they're cryptographically secured or not,
Mm.
and also things backed by collateral to maintain a stable value.
So it's not just, Bitcoin or Ethereum we're talking about. It's potentially much wider.
Precisely. By defining it broadly, Kenya sort of avoids that trap where regulations become outdated almost immediately. This definition can cover everything from the cryptos we know today to maybe a token representing a piece of land or even digital currencies we haven't thought of yet
Right.
without needing constant updates to the law. It's more about what the token does, its function, not just its name.
Okay. And a VASP, a virtual asset service provider, that's just the company offering the service. Essentially, yeah. Any entity that conducts one or more of the specific activities listed in the bill's first schedule, think exchanges, wallet providers, that sort of thing, they're the businesses actually handling these digital assets for people.
What about stable coins? We hear so much about them, especially with some of the global turbulence we've seen.
Yeah, stablecoins are definitely a focus. For that term, interestingly, while some stakeholders did propose changes, the committee decided to stick with the bill's original definition. They felt it was, and I quote, sufficient and all-encompassing to keep the legislation future-proof.
So what does that definition actually say?
It basically means a virtual asset designed to have its value fixed or pegged relative to one or more reserve assets. The key idea for users is, stability. They're meant to offer a stable price point in a volatile market, kind of bridging traditional money and the crypto world.
Got it. And then there's virtual service token. That sounds a bit more abstract. Yeah, think of a virtual service token. Less like an investment, more like maybe a digital coupon or a membership pass. Its value comes purely from letting you access a specific feature or service within an application.
Like in-game currency.
Exactly. Like an in-game currency that only works in that game, or maybe a token that gives you voting rights in a specific DAO, a decentralized autonomous organization. The committee adopted a more precise definition for this, trying to pin down its actual economic function for regulatory purposes.
Okay, that clarifies things. So moving from definitions to like actual oversight, this is where it apparently got really interesting, right? The whole question of who actually regulates these things. Sounds like there was a big debate.
Oh, absolutely.
Yeah.
A major debate. Initially, the bill pointed to the Capital Markets Authority, the CMA, and the Central Bank of Kenya, CBK, as the main regulators.
Kind of splitting the duties.
Sort of, yeah. But then several key stakeholders, we're talking the Virtual Assets Chamber, big law firms like Anjarwalla and Khanna, and companies like Yellow Card Kenya, they all pushed back. They argued strongly for a joint or unified regulatory authority.
A single body. What was their reasoning there? Why was that so important to them?
Well, they raised concerns about potential bureaucracy, having two separate authorities. More importantly, they worried about jurisdictional overlap, who regulates what. And they really stressed the need for a single, harmonized, one-stop shop for virtual asset regulation.
Makes sense. You don't want businesses caught in the middle.
Exactly. Imagine trying to get a license and navigating two different sets of rules, maybe even conflicting ones. They wanted clarity, a streamlined process.
So what did the committee decide? This feels like a pretty big decision for the industry.
It really is a pivotal moment, like you said. The committee agreed with this mission for a joint regulatory authority.
Wow, okay.
And this isn't just about cutting red tape. A single authority could mean faster decisions for businesses, less chance for regulatory arbitrage, and just a more consistent policy approach overall. That's crucial if you want to attract innovation in a sector moving this fast.
And did they stop at just CMA and CBK for this unified body?
No, they actually broadened the scope. The committee also agreed to widen the definition of competent authority to include others like the Competition Authority of Kenya, the Office of the Data Protection Commissioner, and the Communications Authority.
So recognizing it touches everything competition, data, comms?
Precisely. It really reflects that virtual assets aren't just a financial thing. They cut across multiple regulatory domains. It means potentially broader, more holistic oversight.
So with this new potentially unified regulatory power, the next obvious step is, okay, how do companies actually get licensed? How does the licensing regime work under this framework?
Right. The bill is very clear. You can't operate a VASP business without a license, period. And the committee clarified this is aimed at businesses, not, individuals offering services informally.
Okay.
For those businesses applying, there's a key detail the committee agreed on, which is great for predictability. A clear 90-day timeline. The regulator has to provide feedback to an applicant within 90 days.
That's huge. No more waiting indefinitely.
Exactly. It provides some much-needed certainty for potential licensees planning their launch.
Was the license duration itself straightforward, or were there changes there too?
Another significant practical change, actually. Initially, the bill said licenses would expire on December 31st of the year they were issued.
Which could be really short if you get licensed late in the year.
Right. Stakeholders like the Virtual Assets Chamber, Yellow Card, they all pointed this out. Imagine getting licensed in November and having it expire a month later. It's just inefficient.
Yeah, definitely.
So the committee listened. They agreed to change this to a 12-month validity period from the date of issuance. Much more practical. And they also added explicit provisions for license renewal and a grace period, too. Aligns much better with normal business cycles.
That sounds like a really sensible adjustment. Okay, so once a company is licensed, what are their day-to-day obligations? What protections are built in? What do they actually need to do?
Okay, so once they're licensed, VASPs have a whole list of responsibilities. It's all about ensuring market integrity and protecting consumers. First up, directors and senior officers have to pass a fit and proper assessment.
Standard financial services stuff?
Pretty much, yeah.
Yeah.
Some stakeholders did worry it might create high barriers for, new entrepreneurs, but the committee stressed its standard practice to ensure competence and integrity. They even tightened it slightly, agreeing to include prior offenses related to data protection, cybersecurity, or financial services laws, even if they happen in other countries.
Oh, interesting. So no just hopping jurisdictions to escape a bad record?
Seems to be the idea. Yeah, preventing bad actors from simply moving shop.
Makes sense. And cybersecurity, obviously critical in this space, right? Especially with all the hacks we hear about globally.
Absolutely vital. The bill requires VASPs to have appropriate and effective cybersecurity measures. The committee went further to clarify this means complying with both Kenya's Computer Misuse and Cybercrimes Act and the Data Protection Act.
So covering both the technical security and the user data side.
Exactly. Comprehensive coverage aligning with existing digital laws.
And I heard a new safeguard was introduced here, something about audits.
Yes, this is a really significant addition driven by stakeholder input. The committee agreed to introduce a new requirement. Licensees have to commission a system audit at least once every 2 years.
Okay.
And this has to be done by a certified IT auditor. It's not just a box-picking exercise. It forces VASPs to constantly get their defenses checked: infrastructure, data security, transaction integrity, cyber preparedness, operational resilience.
And report back to the regulator.
Yes, the audit report goes straight to the regulator. It's about building trust, really, trying to ensure that when you use a licensed VASP in Kenya, your digital assets are genuinely secure, or at least that there's robust oversight.
That sounds like a strong move. What about leadership structures? Was there a shtig there?
Yeah, this was another quite significant change. The committee actually agreed to delete the entire clause that required regulatory approval for appointing a chief executive officer, a CEO.
Really? Why?
Instead, the focus shifts. It will now be squarely on the appointment of compliance officer. This person will be specifically responsible for ensuring the licensee sticks to the rules of the Act and other relevant laws.
So less focus on the top boss, more on the person directly responsible for compliance.
Exactly. It shifts the regulatory gaze to direct, explicit accountability for following the rules, which, makes a lot of sense in a regulated field.
Okay. What about something seemingly simple, like having a bank account in Kenya? Was that controversial?
It actually was, yeah. Bit contentious. Stakeholders asked for flexibility here. They pointed out that historically, crypto companies have had real trouble getting basic banking services, partly because of cautionary notices from the central bank in the past.
Ah, so banks were wary.
Very wary. But the committee held firm. They observed that needing a bank account in Kenya is, quote, not an onerous requirement. And crucially, they argued that the past difficulties were because there was no regulation. Their stance is now that this bill provides clarity, banks should be more comfortable onboarding licensed VASPs.
So the requirement stays.
The shall remains, yes. They must have a bank account in Kenya.
Okay. And finally, on the operational side, what about ownership changes? If someone buys a big stake in a VASP.
Right. To sort of streamline things while still keeping an eye on who owns these companies, the committee decided to amend the bill, instead of needing approval for every single share transfer, which could be really cumbersome.
Yeah, that sounds like a lot of paperwork.
They'll set specific thresholds. For example, if a transfer results in someone owning more than, say, 10% of the shares, then it needs to be reported and potentially approved.
More like how it works in other regulated sectors.
Exactly. It aligns with practices elsewhere. It allows for smoother operations for the VASP, but still gives the regulator visibility and control over significant ownership shifts.
Right. We've covered getting licensed, operating day to day, but what about when things go wrong, or preventing them from going wrong in the first place? Let's talk enforcement, especially tackling illicit activities. Preventing money laundering, terrorism financing, that's a core goal here, isn't it?
Oh, absolutely central. And one of the most critical gaps this bill closes relates directly to that. Currently, Kenya's main laws on this, the Proceeds of Crime and Anti-Money Laundering Act, POCAMLA, and the Prevention of Terrorism Act, they don't explicitly recognize VASPs as reporting institutions.
Meaning VASPs aren't legally required to report suspicious activity under those laws.
Currently, no, not explicitly. But that's set to change. The committee agreed to make consequential amendments to both POCAMLA and the Prevention of Terrorism Act. This will ensure VASPs are recognized and brought into the same reporting framework as banks and other financial institutions.
That's a huge step for integrating crypto into the standard anti-financial crime system.
It's absolutely crucial, yeah. Brings the virtual asset space into the fold.
And how will they monitor this? Is it just about reporting after the fact?
No, it's more proactive than that. The committee also agreed to a new requirement. Regulators will be able to compel licensees to implement and periodically test anti-money laundering and combating terrorism financing risk assessment tools and transaction monitoring systems suited to virtual asset risks.
So actively scanning for trouble within their own systems.
Exactly. It emphasizes proactive digital surveillance. making sure VASPs aren't just waiting for something suspicious to happen, but are actively looking for red flags, using appropriate tools for the unique risks of crypto.
Okay, so if a VASP does break these rules, what kind of teeth does the regulator have? What penalties are we looking at?
The bill lays out various options: administrative actions, criminal offenses, fines, even jail time. Now, stakeholders, particularly from the industry side, argued for, perhaps lower monetary penalties and less severe jail time, especially for a new industry trying to find its feet.
Worried about stifling growth.
That was the argument, yes.
Mhm.
The committee listened to some extent. They resolved to harmonize offenses and penalties across the board. And importantly, they also agreed to allow for risk-based penalties. Penalties should be, quote, commensurate with the economic gain from the violation or harm caused to the public.
So aiming for proportionality. The punishment fits the crime, essentially.
That seems to be the goal, yes, making the penalties impactful and a real deterrent, but hopefully not so excessive that they crush legitimate businesses, especially early on.
And what about the regulator's powers to investigate? Are they getting stronger tools for this digital world?
Yes, definitely. They'll have enhanced powers for compliance checks and full investigations. The committee agreed to strengthen some of these, including the power to demand access to digital records, even encryption keys if necessary.
Wow, encryption keys too.
Yeah, and they can also potentially order a temporary suspension of services or even freeze specific wallets during an investigation if needed. It shows a clear intention to give regulators the kind of sophisticated tools they really need to operate effectively when evidence might be entirely digital and, potentially hidden.
Right. Okay, looking beyond the immediate regulations, the stakeholder engagement process, it seems to have surfaced some really interesting ideas about the future, right? Proposals that go beyond just the basics.
Absolutely. This work is quite forward-looking. The bill is trying to anticipate where the space is going. For instance, on virtual asset offerings, basically, how new tokens get listed on exchanges. The committee agreed to adopt a principles-based approach. Instead of rigid, specific rules for listing, suspension, delisting, platforms will need to establish their own rules based on broad principles set by the regulator.
Giving them flexibility.
Exactly. It allows for flexibility and innovation, acknowledging that the types of assets being offered will likely keep changing rapidly. Rigid rules could become outdated very quickly.
Makes sense. And stablecoins, again, they came up in the forward-looking part too. Any specific guidelines emerging there beyond the definition?
Oh yes, very detailed guidelines were proposed and seem to have been largely accepted. We're talking requirements for specific regulatory approval before issuing a stablecoin, using qualified asset valuers,
Okay.
and critically 100% collateralization, plus a requirement for ring-fencing those reserve assets,
Ring fencing,
meaning the assets backing the stablecoin must be kept separate and safe, and crucially, they cannot be lent out to earn yield or used for other risky activities.
That's a direct response to some of the global stablecoin collapses, isn't it? Where reserves weren't actually there or were being risked.
Precisely. It's Kenya signaling very clearly. We prioritize stability and consumer protection. If you hold a Kenyan-regulated stablecoin, the backing should actually be there, one-to-one, and kept safe, not gambled with. There will also be requirements for independent audits and segregation of customer assets and the issuer's own funds, multiple layers of security.
That's a very strong stance. What about tokenizing real-world assets? That's another big buzz area, but also raises unique issues.
Similar detailed proposals came up there too. Things like proper valuation, ensuring the collateralization is sound, using professional custodians. But what's really fascinating is the ethical dimension that came through.
Ethical dimension, how so?
Well, there were proposals to explicitly exclude certain things from being tokenized. We're talking sovereign assets, public infrastructure, personal identifiable information, artworks, and any other asset that cannot be transparently valued, legally enforced, and ethically justified.
Wow. So drawing lines about what should and shouldn't be turned into a tradable digital token.
Exactly. It moves beyond just the financial mechanics into broader societal considerations. Is it right? Is it ethical? Is it even possible to properly value and enforce rights related to tokenizing, say, public infrastructure or personal data? It's a really thoughtful inclusion.
That really is. And thinking about Kenya's role globally, any talk about recognizing foreign players or passporting rights?
Yes, that came up too.
Uh,
Stakeholders proposed new sections specifically for recognizing stablecoin issuers licensed in other reputable jurisdictions, and also potentially allowing passporting rights.
Passporting, like in the EU.
Sort of, yeah. The idea is that a VASP already licensed in a recognized jurisdiction, one with comparable regulations, could potentially operate in Kenya without needing a full separate Kenyan license as long as they comply with local rules on things like consumer protection and AML.
That definitely hints at ambitions to be a hub, doesn't it? Attracting international business.
It certainly suggests an openness to becoming a key player, maybe regionally or even more broadly, fostering that cross-border activity. It's quite forward-thinking.
And, inevitably, taxes. I assume there were debates there. Always tricky with new tech.
Oh, for sure. Active discussions. Proposals flew around about VAT exemptions for VASP services, possibly to encourage the sector. And significant debate about the existing digital asset tax, the DAIT. Some even suggested changing it completely, maybe even a new tax based on the value of crypto assets Kenyans hold at the end of the year.
So, still figuring out how to tax this fairly and effectively.
Definitely. It highlights that ongoing challenge everywhere. How do you adapt traditional tax systems to these new digital realities? Finding that balance between revenue generation and not killing the golden goose, so to speak.
And there was a really unique proposal about social responsibility, too.
Yes, this one really stood out. It came from a group called the Mau Children Post-Colonial Elites. They proposed that licensed VASPs should contribute a small fraction of their profits towards things like community empowerment, boosting digital literacy,
Okay.
and even funding blockchain-based platforms for potentially historical reparations.
Wow, that's extending the scope way beyond just finance.
It really is. It brings in broader societal impact, digital inclusion, historical justice concerns. It shows the conversation in Kenya around this bill was incredibly wide-ranging.
And lastly, given crypto knows no borders, was cross-border cooperation between regulators discussed?
Yes, deemed critical. The Asset Recovery Agency, for instance, proposed adding new clauses that specifically mandate cross-border collaboration among regulators.
Makes sense. You can't really regulate this stuff in a vacuum.
Exactly. Recognizing that virtual assets flow globally, this ensures Kenyan regulators have the mechanisms and mandate to work with international counterparts, to track illicit funds, share information, and maintain effective oversight across borders.
So wrapping this all up, what does this mean for you, our listener? This deep dive, I think it reveals a really robust, a really considered effort by Kenya to build a comprehensive regulatory framework for virtual assets.
Yeah, from the very basic definitions to establishing that potentially unified regulator, strengthening the AML and CFT measures, and really getting into the weeds on future issues like stablecoins and tokenization. This bill, especially with all these proposed amendments, looks set to genuinely transform the landscape in Kenya.
And your key takeaway here shouldn't just be about rules and compliance. It's really about setting a sophisticated foundation for the future of digital finance in Kenya, trying to strike that crucial balance, right? Fostering innovation while putting in place really critical safeguards.
Definitely. It shows a clear commitment to market integrity and, importantly, to protecting you, the consumer, the investor in this space that evolves so quickly.
So the final thought to leave you with, as Kenya moves towards potentially approving this bill, with all these refinements, what opportunities and maybe what challenges too will this new landscape actually unlock? Could it really position Kenya as a hub for virtual asset innovation and investment?
And perhaps just as importantly, how quickly will this framework itself need to adapt and evolve? Because one thing's for sure, virtual assets aren't standing still. Their march forward is pretty much inevitable.